Welcome back, and time for a conversation with Christy Mathai, Fund Manager Equity at Quantum AMC, joining us. Christy, great having you. Let me first start off. It's such a difficult market, but at the same time, we were just discussing in the studio that if one were to look at it in the medium-term horizon, could it be something of a very interesting time to actually start buying or nibbling on to names? How are you looking at the current market setup? How are you looking at the next 6 months and maybe the next 2 years?
Sure. Thanks for having me. So clearly, if you were to just look at the past year return, I'm talking about the calendar year 25. So, large caps have done somewhere around 8-9%, small cap negative number, and mid cap somewhere in between. But if you were to look at the broader market, the pain has been much larger, especially in the small and mid. We're just looking at the small cap 250 names, and roughly around 64% of them has given sort of negative returns, and 34% is roughly less than minus 20%. So this also brings in a lot of opportunity. So to pick and choose from. Large caps have done well, and courtesy the earnings growth. And this year also things may look up because large component of the index, which is banking, continues to sort of do well in terms of earnings. But there is possibly opportunities in some of these segments which have fallen quite a bit. And if you were to look at what we have been doing, we have been adding into some of these names. For example, we added into a cash logistics names which have fallen quite a bit. Again, from the small cap pocket. So that is where the opportunity is also from our point of view. But the larger setup, continues to be large caps in our funds, where we find this earnings visibility continuing on, when we think about a 2-year visibility.
Okay, and Christy, hi, good afternoon. Talk to us about what the generic strategy in terms of sector allocation should be in the market. Is it safer to be with the large cap names or not really, because we've seen pressure on some of these very large cap names as well from the IT and banking space? Or would you recommend a very bottom up approach but from the broader end of the market?
Yeah, so clearly our approach has been bottom end and bottom up, and when we do that analysis, what comes or what fits into in terms of our valuation criteria and the growth looking forward are primarily some of these large banks, some bit in IT services which have been present for quite some time. Looks like the current earnings season also things are stable. There are some pockets where the discretionary sort of demand is coming back, especially if you were to look at the US BFSI, some part in Europe as well. So things are looking up on that front. And the broader spectrum, as I said, of the part of the market which has corrected quite a bit. So we have added to a pharma name. Again, it is very bottom up because some pharma names have done extremely well. So we've been trimming out of those positions. But some we have added to logistics names primarily, which trades, which is bulk of India's EXIM volumes. It carries. So it is a mix of these bottom-up approaches, but if you were to just sum it up, again, you continue to find opportunities in banking as a whole, because that is where the larger upside looks, especially from a 2-year perspective in our view.
Okay. Christy, where would the tilt be in a market like this in terms of are there broader sectors that you're looking at in terms of fresh buying? Something that is standing out for you in this market?
See, if you were to just look at where possibly the earnings growth could be, ours is a combination of buying any stock at a sort of a margin of safety, which we want to buy stocks minimum at 20% discount to its what we deem as an intrinsic value or fair value. From that vantage point, when we look at the current market, the opportunity by and large continues to be in the financials. Some of the insurance names which we have been adding, part of it is life insurance, some bit of it is in health, and some of these are the larger point, but banking, as I said, is an opportunity. Autos, we had a very large exposure, but we have been trimming because, the volume growth has been pretty strong, and a lot of these valuation metrics already captures what could come. Some pocket of opportunity could still lie within the two-wheeler mass segment, which we continue to hold on. So, it's very bottom up, very grounds up in that sense. And these are the few sectors where we still think with a large, our allocation is primarily to the large caps from that point of view.
Okay, so primary allocation towards large caps. But Christy, I'm just trying to understand what would be some themes that would still continue to function in an everyday life. It could be FMCG staples, could be some of the BPC companies or food delivery or quick commerce aggregator companies. Do you believe that they are largely shielded in terms of largely shielded from the way the market is performing right now? Do you believe those could be some pockets worth looking at the moment?
Yeah, so some of these themes that you said clearly stand, their pockets of strength in that sense in a market like this. But in our view, if you were to just, it could be more a tactical call from that perspective. But if you were to really think slightly long term, we are possibly looking at some 7-8% EPS growth in some of these pockets. I'm talking about the larger FMCGs. The GST settling down, there could be some volume benefit that could come through. But by and large, a lot of them are trading still about 50, 60 PEs. So from our outlook in the segment is, there could be a time correction which could be more long-term in nature. And we have been into it for some time because there is no reason why they should trade at such higher multiples. From a tactical standpoint, it may be, the next 6 months, if the market continues, this would look up, but it's not an allocation decision. This we do not consider as a major allocation point at this point in time. And talking about some of the other themes, more of the internet names, see, again, here the valuation still continues to be on the higher side. They could have faster growth. But when we put it from our prism of value investing, it doesn't actually fit the bill. So we are observing, but we have not allocated to the segment.
Christy, how should one look at metals? Because they've seen a phenomenal rally. What next? Are these valuations sustainable? Can they continue to re-rate upwards? And our balance sheets, what are the structural stories that are changing? Our balance sheets far more cleaner now. Is that why the equity community is more willing to give them the kind of valuations that they are getting?
Yeah, so metals have clearly done well, and we did have a few names in our portfolio as well. But by and large, when we look at it at the current juncture, it prices in a lot of these optimisms in the current numbers, especially if you're looking at the ferrous side, the safeguard duties did help, versus the exports, even though that continues to be the Chinese exports continues to be large, but, safeguard duties did help. And in our view, there could be a volume uptick that you could see in the near future, but the prices are where it's going to be, and it's going to be largely global led. On the non-ferrous side, certain themes do look good, but they've not been part of a portfolio primarily because of valuations. So we like it, but we wouldn't say, this is the time to get into it. Possibly, some about few months earlier when things were looking much cheap is when we could make those allocation decisions. So right now we will possibly keeping our allocations or trimming out of some of these names which have run up quite a bit.
See, how do you look at realty as a pack? Of course, you're seeing very, very sharp correction on the realty index itself today. But where within the cycle do you believe we are? Because most people we're speaking with are saying we're somewhere in the middle. So there's still 2 to 3 years to go. If the unwind on the cycle were to happen, that itself would give, say, a 40 to 50% return to investors. I'm trying to assess where in the cycle are we, and if that unwind were to happen and push upwards, you could see very, very strong returns over the next maybe couple of years.
Yeah, I sort of agree with that view, and we are also looking at this very closely. So far no names have come in, but things are getting at interesting level. We continue to believe that we are somewhere in the middle of the cycle, and so far we have seen a volume sort of not being so volume growth not being so great, but value as a whole is still holding up. And some of these names have corrected anywhere between 30 to 40%. So, this sector does look something which, it looks attractive to our minds at this point in time. Only certain markets may not be so great. For example, folks exposed to the Delhi NCR, there could be some correction that is happening. But again, some of this could be just transient. So we are closely watching this sector, and it does look, attractive in our view at this point in time.
Okay, so that's on the realty space. But Christy, really appreciate you taking the time out and speaking with us across a wide spectrum of sectors and what the strategy should be. Once again, thanks so much.
Thank you.
Okay, viewers and